Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Priest.
Hello, everybody.
And we're with The Road to Retail. On our podcast, Tracy and I hope to offer tips, insights, ideas, and examples for how small, emerging, and challenger CPG, consumer packaged goods, brands can build their business. Everything from determining if you're ready to grow, where to start, how to prove it online, how to go about securing distribution at a national retailer, driving your business with the end consumer, and how to go about finding an investor if that's important to you. The bottom line is, we would love to help you be successful by highlighting the many important factors that go into establishing and growing your brand.
Bruce and I have been working in CPG commercial operations for over 30 years, working on brands of all sizes. By commercial operations, we mean sales, marketing, trade marketing, new product development, broker and distributor management, new product development, brand M&A, and financing. As a part of our show, we bring our guests that are brand founders and leaders, agencies, Amazon specialists, sales agents, contract manufacturers, retailers, and investors to discuss their experiences and share their insights with the audience.
To keep up with the show, please subscribe to the Road to Retail podcast on Apple Podcasts, Spotify, or YouTube. Leave us a review and consider sharing the show with a friend or colleague that may benefit from the content. You can also check out our website to learn more at www.road2retail.com and follow The Road to Retail on LinkedIn. We would love to have you along for the ride. Today's show is sponsored by Retail and Response. You've heard it a million times on this podcast. It's not about getting your product on the retail shelf. It's about moving product off the shelf and hitting the retailer's sales velocity hurdles fast. Otherwise, they're going to begin the discontinuation process. Trust me. A slow sales start can be fatal to your brand. You need consumers coming in seeking your brand. You know, the one they heard about on radio or saw on TV. If you think radio or TV advertising is too expensive, you need to speak with our friends at Retail and Response. With over 30 years helping drive hundreds of millions of dollars of sales for their clients, Retail and Response can get your brand on radio and TV for pennies on the dollar. Check them out at retailandresponse.com. That's retailandresponse.com.
Hello, everybody, and welcome to the latest episode of Road to Retail, where we interview friends and colleagues in the CPG industry. Good to see you, Bruce. Welcome.
Tracy, how are you, my friend?
I'm doing fantastic. We've got an awesome guest today. So, Bruce, tell us who we have.
Oh, thank you, Tracy. So today we're joined by Teddie Townsend from CG Sawaya Partners, where she is a director and she's also lead on their emerging brand business. So Teddie, thanks for your time today and thanks for coming on the show.
Well, thanks for having me, Bruce and Tracy.
So as we jump in here, Teddie, why don't you just give the folks a little bit of background on kind of your career path so far and how you've ended up in the seat you're in, and then we'll press into specifically what you do in a bit.
Yeah, of course. So I have been in some version of Sawaya Partners for the last 14 years, almost my entire career. I went to college to be a journalist at Kenyon College in Ohio, and somehow ended up in St. Petersburg, Russia, speaking Russian for a little bit. Got very interested in economics and finance. Ended up deciding that I didn't want to write about the financial world, but rather wanted to be a part of it. And so when I graduated, I somehow convinced a boutique investment bank to hire me to write all of their marketing materials. I did not know how to use Excel or what accounting was, but they took a chance on me and told me that if I could teach myself those things, that they would hire me on as a full-time analyst. So I bought myself a couple accounting books and managed to get a real job as an analyst. And then about a year and a half later, joined Sawaya, where I was able to focus on the consumer space and have been there ever since.
That is awesome. You need
From
to
a bar in St. Petersburg to investment banking.
Write a book, Teddie, about your journey from St. Petersburg, Russia to Sawaya Partners.
It's an interesting trajectory. There's a lot of finance majors around me. I'm a little bit of a standout in terms of my background.
Yeah, I'm sure when you go back for the alumni speaker series at Kenyon, they're like, now, how did this happen?
Yeah, yeah. Kenyon didn't have a real. Our economics was wonderful as a course or curriculum, but it was more around reading about the theory of economics versus the practical implications. So different approach to finance than a typical finance background.
All right. Tracy?
Awesome. So let's just jump right in, Teddy. So tell us a little bit about, what Sawaya Partners does and also then their role in working with small emerging brands.
Yeah, of course. So Sawaya was just as quick background. So Sawaya was founded about 24 years ago now by Fuad Sawaya, and the impetus for that was there were a lot of big banks advising. He wanted to create a boutique that was exclusively focused on the consumer space and only provided M&A advisory services. So very specific, very deep expertise, and really committed to getting clients the best outcome. And so that was sort of the foundation of the business. When I joined, we had three verticals within Sawaya. We had health and wellness, home and auto, food and beverage. We operated across those verticals with clients up and down the board. So it was large corporates like Bayer and Johnson and Johnson, but also kind of higher growth businesses like Baby Ganix and Method were innovating in legacy categories. And that was really our bread and butter, bringing core expertise to those types of clients, primarily on the sell side, but sort of across the M&A spectrum. We had 100% completion rate. We took on deals that we knew we could get done, and that really helped us build an incredible franchise across the consumer space. And then about call it 3 to 4 years ago, as a firm, it started to make sense for us to look towards kind of the next moment for us, the next iteration of what Sawaya could be. And so we actually hired our own investment bank to advise us, which is very different. It was sort of an unusual experience for us as bankers to have bankers tell us how to run a process. But we hired our own banker, and they ran a sell-side process for us at Sawaya. And we ended up partnering with Canaccord Genuity, which was a Canadian publicly traded bank. They didn't really have a consumer business, and so it was very incremental. But it also allowed us to really expand our product offering because they had a very large equity capital markets business. They had research capabilities. They had global presence. So that was really exciting for us. So that kind of gets us to today as business. My journey alongside that was predominantly in the health and wellness space. It was where I was spending a lot of time, and then some of our home and auto deals as well, until about 4.5 years ago, when we saw a pretty material change in the way consumer businesses were funded. So all of a sudden, kind of in 2017, 2018, you started seeing real venture dollars coming into the consumer space, which had not historically been the case. Historically, consumer businesses, maybe growth funding, but this idea of venture was really not something that was a meaningful part of the growth trajectory of consumer brands. So anyway, so that shifted along with this whole D2C revolution as a new business model. And so we as a firm had never really spent time on the earlier stage side because it just hadn't been a meaningful part of the consumer journey. And we were now seeing it as a meaningful part. And so the idea was, let's create a vertical so that we can get access to companies earlier, so that we can be more flexible in terms of the product offering that we're bringing to them, and have more flexibility in terms of just generally how we approach companies. And so that was the really the thesis around building out an emerging brands vertical. That has evolved over the last 4.5 years. So I lead that effort. It runs in parallel to our traditional M&A partners. So each of our, MDs sort of runs or covers a certain vertical within consumer, whether it's services or, VMS, OTC, broader consumer health, home and auto, food and beverage. We have coverage across all of those. That's sort of a traditional M&A model. But emerging brands allows us to get really creative, which is awesome. And I think even more exciting today than it was 4 years ago, because today what you're finding is there's a lot of brands that are raising capital. My group is allowed to go talk to businesses when they're doing, 2 million, just to really understand what they're doing, get that as a touch point. We're not advising, but we're helping. It's a lot of goodwill.
Right.
It allows us a lot of touch points. So then we can turn around and go to the big strategics and have a lot more insight into the ecosystem of innovative brands up and coming. So that's kind of a side benefit of this access. We spend a lot of time doing large minority rounds, again, across our verticals. So brands like Love Wellness, Back to the Roots, Touchland, businesses like that, where we're kind of supporting them on their journey. And then it also allows us to act as a sell-side advisor once those brands get to a certain point where they're looking. It means I'm very collaborative with my partners in terms of sectors they cover, both from a kind of, hey, I have this amazing brand, do you have sector expertise, but also just broadly in terms of their marketing. And then the third leg of the emerging brands group, which is frankly the most exciting, especially today, is I like to call it like Teddie's creative journey, but it's like, how can we really innovate in this space in terms of the products that we're offering? How can we differentiate? How can we bring something that meets the moment in time, as opposed to just offering the same thing? Oh, we can sell your business. Well, okay, that may not be applicable to everybody. Is there an alternative to that narrative? And so anyway, so that today is where I am in particular spending a lot of time in terms of thinking about the capital journey and how you can really support companies across different dimensions of their business.
That's awesome. Wow.
That's a very detailed answer, but good. But you're in an exciting space. So, let's press into that a little bit, Teddie. So with all the brands that cross your desk or come through the door of your firm, what do you look for in an emerging brand that tells you, we can invest some time because they actually might be on to something? I mean, Tracy and I, we've interviewed all kinds of founders or people call and, they want to talk about their business. And in some cases, all they really have is a hobby or they have an idea. And, I'm kind of in awe of all the entrepreneurs who have the courage to go for it. But what do you need to see before you're like, you know what? I'm returning this call and we're going to take that meeting?
Yeah. So when I first started doing this, I took every call. I spoke to everyone, which meant I spoke to a lot of people who afterwards I kind of scratched my head and said, I'm not 100% sure about this one. But I learned a lot about like what works longer term, what doesn't work. And also, what's interesting for us is we have a really good lens in terms of the M&A space. So I sort of know what is interesting from a strategic perspective. That's kind of the basis of where I go from a conversation. I would say there's two things. One is the founder. And I have found that to be, it's not even critical. It's just, it's so fundamental to a brand's potential, I find. And, some investors, they like the idea, that's what they'll invest in, or they'll invest in the person. And I don't think you can separate the two. I don't think like charisma gets you 100%. We've seen how that works out, right? A lot of the time you have the charisma, but not the idea. And at some point the two diverge and there's no longer a good business there. But I do think sort of the initial starting point, especially at the earlier levels, is this person committed to this idea? Do they believe in it? Do I see them doing every single role, doing everything they can to make this a success? And all of the founders I've worked with have that. They have some just incredible drive around building their vision. I think the second thing is, does the business itself have anything differentiated about it, right? There's a lot of categories where there's a lot of noise. If you're launching another, call it gummy vitamin, for instance, right? Gummies, it's very saturated. There's a lot of new entrants. There's not a lot of science. The category itself blew up. Now it's kind of, it's not on the same trajectory it was. It's still attractive for a lot of reasons, but perhaps it's not where it was. So if there's a new entrant to that space, what are they bringing to the table? Is it a marketing play or is it real innovation? Are they addressing an unmet concern or an issue that there's an opening for them to really position themselves at? That's interesting. And so that's the other thing I look for is there real differentiation here? Are they really serving an unmet need, or is it like a good marketing tactic? And then I think the third thing, which is sort of, it's not secondary, but it's not as important in the initial conversation, is what's the sustainable growth path here? What's the distribution play? How can it sit on a shelf somewhere? Can it continue to scale? How do they think about their consumer? How many SKUs do they need to get to scale? Those secondary questions, which really relate more to what the acquisition endpoint is in terms of the viability.
That's awesome.
Well, we talk about differentiation all the time. And Teddie, one of the things Tracy and I did early on in Road to Retail was we interviewed about a dozen buyers at very large retailers and asked them what they look for. And one of the answers we got, which I'll never forget, this person said, I do not need any more cut and paste brands. How are you different and how are you going to drive incrementality in my category?
Right. Yeah. Right, which is very important. How do you, if you're thinking about a basket, are you replacing something that's already on the shelf or are you adding something new? And that's kind of the lens I take as well, which is if you're replacing something, are you better than them or is it a better alternative? Are you upgrading the consumer experience or are you adding a new consumer experience that is relevant?
Yeah,
exactly.
So as Bruce says, you're not interested in the 12th brand of gluten-free cookies.
I mean, if they taste better than every other gluten-free cookie or if they're bringing something else, I think sure. But if all they are is another same ingredient profile product, then probably not. I also think, Tracy, what's interesting with that is you sort of had that mentality 4 years ago because there was so much money. And so if there was a lot of money going into categories, you had a lot more money to spend. It was a lot cheaper to get access to consumers. And so you could have the 12th gluten-free cookie brand that could get to 30, 40, 50 million of sales by raising 20 to 50 million dollars of capital. Now, that's not a very attractive business model, but from a headline perspective, at the time, it looked really good.
Yeah. So next thing we want to talk about. So talk to us about when you represent a client looking for either a strategic, or financial acquisition. What are those folks looking for in an acquisition?
I think it depends. Everyone has a goal in mind. Every founder, when they start a company, a lot of them have this strategic exit in mind, and I think that's great. Mm-hmm. But if we're realistic about how most businesses trade, it's not to strategics. A lot of them trade to private equity funds or like middle market corporates. Having a Unilever or P&G or a Kenvue as your kind of North Star and the only acquisition that makes sense is not generally a great way to go to market. So I think, for us, what's really important, like I mentioned, we have a very high completion rate. Part of that is due to the fact that when we pitch for businesses, when we have conversations with founders, we don't really pitch the best case scenario, right? That's part of the discussion. Like this could happen, and this is obviously what we're going to work for. But this is what's happening in the market, and this is a realistic scenario for you. So as you think about selling your business, if the realistic scenario doesn't make sense, you probably shouldn't be taking the business to market. And I think that's a really important narrative because we look at the last 2 years, we've passed on a lot of deals and they have not gotten done. And it's not because the businesses themselves were bad. A lot of them were great companies, but they may have had one or two things that just weren't perfect, that didn't set them up for success with a strategic buyer for whatever reason. And the problem was, without a strategic buyer, they were not willing to transact at what a private equity player would pay in this market. And so you see these deals not getting done. And I think that's not good. It's not good for the companies. It's not good for the investors. It's not good to have that disconnect. And so we really look for alignment up front. What are your goals? What do you need to achieve to make this deal work for you and your investors to the extent that they're there? What are the key milestones for the business, right? If you have, we call them good news updates. You want to have good news updates during a process. You don't want to have surprises. There's a lot of things you can't control, but we like to control as much as possible. So, retail launches. If you have a major retail launch happening and you want to sell your business, you probably don't want to go to market and have that retail launch in the middle of your process, because if anything goes wrong, if you have to adjust, now all of a sudden you're like on your, you're justifying your performance as opposed to being excited about it. So we look for all of those things, alignment up front in terms of what the goals are, what we're seeing in the market, what we realistically think that you can achieve? And then also, how do we make sure from a process standpoint, timing makes sense, both for, again, your goals as the client, but also in terms of the key milestones, whether they're distribution or even financial milestones, right? There are brands that their profitability is going up, they're doing cost savings, their margins increasing. In this environment, people don't want to give you credit for things they haven't seen. So you want to make sure that you give them enough touch points and validation for what you are doing as a business, so they don't have to create a narrative. They've just got the data that supports it. So that's, Tracy, it's a long conversation. We spend a lot of time with people working through that, but those are kind of the important things that at least come up for us in terms of how we think about launching a process and preparation.
Yeah, that makes sense. So you don't want to announce during an update that you lost distribution at Walmart.
No, I would say that's probably if not a deal killer, a real value hit. So and to be fair, I think the other thing is people have gotten smarter, right? The investors who are participating today, the acquirers who are participating today, they don't want to step into like a blow up. They don't want to be embarrassed. So for them, if they know something is about to happen, they're going to say, okay, I want to see the sellout data. It's great that you're launching into Walmart. A lot of people have launched into Walmart and not done well. I want to make sure you can sit on the shelf. And so, or the same could be said for a new product, right? If you're getting into a new adjacency, that's wonderful. A lot of brands have tried to go into new categories. I want to make sure you actually can, because part of my underwrite is that this brand can expand. And so, part of it is also understanding the buyer psychology here, which is like, are they really risk on? Not really. So if you can make sure that you validated that, it's much more impactful, both from a value driver, but also to the extent that it's a binary decision from somebody.
Yeah. So during the selling process, I've been involved in a couple. The fewer moving parts and known unknowns, the better.
Generally,
that's why I mentioned that, Bruce, because I
did laugh. I did laugh one time during one. I was told by the investment banker representing us that I should make sure, as the commercial guy, we don't miss any of our numbers. I was like, yeah, like I missed them during normal times. But thanks for the counsel.
I think I've said that before, Bruce. So I may have to stop telling people not to miss their numbers.
That maybe some people need to be reminded. I was always the guy in the corner kind of foaming at the mouth. Just let me off the chain. We're okay. So Teddie, the flip side here, when a brand comes to you and you help them, and let's say they look pretty good on the surface and you just went through a lot of detail, they think they're ready to transact. Can you talk to the audience about like how big do you sort of have to be? What kind of information will you have to bring forward? What's the time from like first date to the sale going? I mean, we've heard very unrealistic things. It's like, this will take like 90 days. I'm like, nah,
that's bold.
Not really. Well, these are brand owners that they just have no idea. So since this is what you do every day, hopefully you can pull back the curtain a bit and say, usually they're going to want to see this much data, this many years of financials. You should be about this size. I mean,
yeah.
What do you say?
So I think there's a couple of things. I tend to refer out a lot of deals to actually other bankers who have no affiliation with Canaccord. And part of the reason for that is we are specialists. Anyone who positions themselves as not a specialist is probably not being honest. And there are bankers who specialize in smaller deals. It is an entirely different network of people. And they actually do the same thing. They refer me deals that are larger than where they spend time. And I think that's how it should be, right? So you ask about size. It's entirely dependent on where the brand is, right? I've had people call me up who are doing 10 million of sales, who are profitable. They've never raised any money. The founders decided that it's time to sell. That's not something I'm going to advise on. It's not something I would be well positioned to advise on. I would not be the best person to do it. Not because I don't understand the brand, but because buyers for a $10 million brand are very different than buyers for a $50 million brand. Investors for a $10 million brand, very different than investors for a $50 million brand. So I think number one, it's less about what size is best to transact at. It's, okay, are you ready to transact? Do you want to transact? What are your goals with the transaction? So that sort of dictates who you talk to from an advisory standpoint.
Right.
Right. I mean, Bruce, that it's sort of like a category perspective, right? You're going to talk to an advisor who's got the expertise in the category. I would say size is the same conversation that you should have with your banker. I think there are different impacts in terms of who you're going to talk to at different sizes. Now that's a separate conversation, right? I've had brands who tell me, that they want to be able to talk to the Unilevers of the world. Well, if that's the case, you probably have to be more scale. Typically, we see things above 75 million starting to get that sort of larger strategic interest. Now, it's not an all-encompassing statement, but generally speaking, that's what you find. If you're below that level, the interest is probably going to be less. So if that's what your qualification of a good process is to make sure those people are involved, you sort of want to make sure you're at a size that's interesting for them. If you're below that level, you're talking to call it more of the middle market players, more smaller private equity groups. I think that the last piece on size I'll say is, if you have a number in mind for what a sale needs to look like. So say you have a business and you say, I need to sell for 100 million for the numbers to make work, for everything to make sense for me. The best way to think about that is from an EBITDA perspective and what's the implied, like, what are the precedents? What are we seeing in the market for deals that are similar? And so if you need 100 million and you're doing, 10 million of EBITDA and deals in your category at this time are trading for 10 times, then that's amazing, right? It's probably a good time to go to market because there's probably a private equity owner that can, find a way to meet your valuation. If you need 100 million and you're doing 2 million of EBITDA, or if you need 100 million and you're doing 2 million and your deal is transacting for 10 times EBITDA, then probably not the right time to go to market. So I think size, it dictates who you should be working with. It's going to dictate who you should talk to as part of that process because people just won't be interested in certain sizes. And it's also going to dictate when you go to market, depending on what outcome you either need to achieve or want to achieve. As far as your second question around kind of process and timing, more and more we're seeing advisors getting hired earlier. And that's for a couple of reasons. I mean, you guys have been involved in transactions. You probably remember when it was pretty standard to have a quality of earnings done by the buyers post LOI. It was very standard to have them do brand studies and everything. A lot of that work has now been actually pulled forward and on sellers as opposed to buyers. And that's primarily as a way to mitigate risk, because what people found is that if you push a quality of earnings to the buyer very late in the process, if anything comes up, you're now in exclusivity likely with someone and you don't have a lot of leverage, versus getting it done up front, being able to dictate some of the, being able to have a say in how it gets put together, and then really going to market with a very clear set of numbers that it limits surprises on the back end. What that means is a process, at least the thinking about a process, starts a little bit earlier. So you typically see brands engaging with advisors, call it 9 to 6 months ahead of a process itself. Now that may be shorter, maybe it's 3 months, but you probably want at least 3 months to just prep for the business, whether you need to do a quality of earnings. We've recommended brand studies in some cases, right, where we know that there's going to be questions around competitors, differentiation, demographics, right? So those kinds of things we pull forward as a way to really mitigate any potential concerns in the process, mitigate questions we know are going to come from buyers, have that third party report that we can just serve up and say, look, we actually already validated this stuff. Our numbers are, third party validated, et cetera. So again, you probably want to start talking to an advisor 6 to 3 months ahead of time, at 3 months being on the shorter end. And then once you kick off a process, which is kind of your banker, right, making calls and doing actual outreach to the market, 6 months is pretty standard. I think if you need a process done in less than 6 months, that's suboptimal. You're pushing people to move faster. People don't move fast anymore. Strategics do not move fast. They need education. They need to be kind of brought in. They have multiple constituencies who have to, talk to each other, learn about the business. you don't want to force people to move fast because you're going to lose people. And so if your goal is to maximize participation, valuation, etc., you kind of want to be able to give yourself time so that everyone can meet your deadlines and you're not losing people because they can't hit certain things. So 6 to 9 months is a pretty standard both sell side and frankly growth process as well.
So, folks, before we kick it back to Tracy, one of the things that Teddie said, I just want to reiterate, is doing the quality of earnings, which is basically, for those who aren't familiar with the term, is just a really deep dive to scrub your financials to make sure there's no surprises. There's nothing under the table, not devious, but just something unknown. And then also doing the brand studies, whether it's competition or to validate brand equity. As Teddie said, if you do all this up front and you find something weird, no one knows it's weird except you, and you have time to address it and work on it. But if you get deeper into the process, and if you've gone to exclusivity, which means you've now signed documents where you're only working with one person, and something weird comes up, they now have the hammer. And things can get a little screwy from there. So I just wanted to add a little bit of color there. Tracy?
Awesome. So, Teddie, talk to us about the financing options that are available these days for small emerging brands.
Yeah, I mean, there's the traditional kind of go raise venture capital or family and friends, depending on where you are as a business, right? The earlier you are, the less institutional it is. So that's more like family, friends, angel networks, things like that, Kickstarter campaigns. Again, that's relatively early. Then you get into sort of the seed, Series A venture funds. I would say, Tracy, what has happened is that there were a lot of new funds created in like 2019, 2020, 21, as well as traditional tech and healthcare funds that started playing in the consumer space. That has been completely eviscerated. So you've seen about, I think it's something like 50% of the funds that were participating 3 years ago are no longer participating today. So you have a much smaller universe of potential funds, a lot of whom haven't done a deal in a while or haven't returned any capital. And so they're still kind of in a phase. So the capital options are smaller, and the threshold has increased in terms of how they're willing to transact. But that's still an option for brands who are raising, I don't know, between 1 and like 10 million. You still see kind of activity there. As you sort of move up the food chain, right? If you're looking to raise more than 20 million, depending on what the components are, there are, a handful of growth funds that are very active. There's also family offices that are looking to participate. Again, the threshold is increased in terms of who's writing those checks and how they're thinking about the businesses. I think what people are realizing is that it doesn't really make sense for the like traditional consumer businesses to be raising a seed, a Series A, a Series B, a Series C, a Series D. Like that trajectory doesn't really make sense because most of these businesses are on either a private equity or a strategic exit. These aren't really IPO candidates. And so having these multiple rounds kind of doesn't make a ton of sense. So you see a lot of activity in that like Series A, Series B, with more traditional growth funds who really have operational competencies, who are looking to deploy $20 to $75 million of capital, and who can kind of add value, but they think of that as last money in. So it's almost like an alternative to a private equity deal, right? They're coming in as a minority and really helping a business get to that 75 to 100 million of sales, at which point they can exit. So again, you're sort of talking to like maybe later stage venture growth pockets of private equity groups. Once you get to a scale where you're looking to sell a majority, you're talking to sort of the traditional, depending on what size you are, the traditional private equity participants who can take a majority stake, or you're talking to strategic participants, again, depending on how big you are.
Right. So kind of a part B to that question. So what kind of checklist does a small emerging brand need to go through to determine whether they're really ready to go raise money?
I mean, part of the question is like, do they need money, right? I mean, so if they're like, hey, I need 5 billion to make my idea work, okay, then they don't really have any option. They have to go raise money. I think it's always best to have the checklist fully checked. I think of things again. Do you have a product market fit? Do you have differentiation? Do you have a clear path on distribution in terms of how you're scaling up, whether or not you already have proof of concept, or maybe you're 100% D2C, but you have a price point and a product that you think will perform on the shelf. um, and also what's the margin profile that you're looking at? Are you a business that's going to require multiple rounds of funding to scale, or are you a business that has a very attractive gross margin for your product category that happens to be spending a lot on marketing today to sort of get the ball rolling, but once you're at scale, the P&L starts to make sense. So those are the things people look for now, right? That profitability marker is incredibly important. Unit economics, incredibly important. If you don't have a business that can make money, it's very hard to raise money today. And frankly, it always should have been, but it's sort of, people stopped looking at the bottom line for a period of time, and we're seeing a full reset now, both on what deals are getting done, but also, people are finally starting to accept down rounds, right? That was like a bad word 2 years ago, but when you look at some of the valuations that people came in at in 20 and 21, they didn't make sense then. They really don't make sense now. And so having a view on like, what is the real value of the business? Who are the right investors to come in? Is this a business that can scale sustainably? Is, I think, kind of fundamental on my checklist, at least for businesses, of like, where is this going, right? Like, it doesn't have to be the most innovative product in the whole world, but does it have a reason for existing? And is that reason profitable? And if the answer is no, it's going to be very hard to raise money.
Right.
So Teddy, do you find IP and patents particularly helpful, or is that just part of the overall kind of recipe for differentiation? You've got these moats. You've got a legal moat because you have a patent, or you're the only one with a license for X.
It depends. I mean, in the consumer space, IP tends to be like proprietary formulas, right? It's less about patents and things. I mean, they exist. Design patents exist. Those are great. Obviously, trademarks, things like that, you need to own. Formulations, there are certainly some businesses that have real proprietary formulas, but I would say the vast majority of consumer businesses are third party sourced, and the third party either owns the formula or it is their formula, whatever the case may be. So I think having IP is important. It's a differentiator. What form that IP takes can be in a lot of different formats. Again, patents may not be applicable for what the product is. There certainly can be those design patents. Those can be valuable. A brand name that's recognizable, assets around the brand that are valuable, things like that. But proprietary formulation is kind of what I think of. And again, generally speaking, that's not an ownership of a formula. It's maybe a kind of how the actual product gets created, where you have a proprietary know-how or something like that. We see less sort of, I'll call it like, it's not as if it's like tech or healthcare where you see those like real patent books that someone brings out and says, I own all of these patents. Like, we don't typically see that on the consumer side. So you look for other areas where they can have a moat.
So Teddy, one last topic here, and then we'll move off of funding, but money's kind of important to run a business, and you're an expert, so we want to take advantage of the time you've been gracious enough to share with us. So let's say that an investor has now, they've put together a nice deck, they've raised some money, even if it's just, friends and family or a local angel network through a university or something. What should an entrepreneur look for when they take money? Tracy and I have heard, I just need cash. I know exactly what I'm doing. And then there's other people who are like, I want value added money. I want someone who can open a door at Walmart. I want someone who knows how to sell on Amazon. So that's one thing. So what kind of money should you take? And then we've also come across lots of people that don't have a great idea that once you take money, you sort of owe these people communication. I've had people say, I had no idea they'd want to talk to me so much. So what kind of reporting do you think an entrepreneur needs to mentally, in his or her mind, be ready to share? Because no one's going to give you money and say, well, Bruce, get to me when you can. Let me know how it's going one day.
Yeah. Yeah, actually, one thing before we go there on your last question, the one thing I didn't mention is the regulatory piece, which I actually do think of as proprietary on the consumer health side, because
Good point.
certainly on like, on the OTC side, obviously, uh, that's sort of critical, obviously, to even go to market. But on the broader consumer health side, what we have seen is the claim set is incredibly important. How you get those claims is around running clinicals. And so if you have your own clinicals, that becomes a real moat where you have a claim set that you and you alone are allowed to make. Sometimes brands have ingredients that have clear claim sets, right? So that's not necessarily proprietary to them, but it's a claim set that they can make as a differentiating factor. So again, not a patent, but that is incredibly important. And frankly, it's the claim set is binary from a strategic perspective. If you cannot make certain claims, or if you're making claims that you should not be making, it's a non-starter, but it's also a differentiator, a meaningful differentiator for brands that are able to do things. So I forgot to mention it, but I think increasingly especially on the health and wellness side, that's
No,
very important.
that's a very good point, because as you know, and Tracy and I see it all the time, is things kind of go in cycles, whether it's retailers or regulators, now and then, and especially with what's in the news right now, different countries are kind of persona non grata, and you have to say, do you source any ingredients from here? Do any of your components come from here? And do you have I don't know what the word is, a chain of control that exactly where the stuff was at all times? I mean, so that's interesting. So anyway, Teddie,
Sorry, back to your other question.
yeah, reporting and what kind of money should someone look for?
Yeah, so I go back to like goals. So if you are looking for just money, you're doing fine, you want to bring in whatever 5 to 10 million or whatever it is, you don't think you need any help, um and you also think this is like you have a clear path to an exit, you're probably just talking to traditional venture groups, maybe some family offices, but you're not necessarily prioritizing their value add. And so you probably don't want to talk to people who do feel quite strongly that they have value add, because you're going to have a little bit of a disconnect in terms of how they view their role and the role that you actually want them to play. So I think, syndication becomes more valuable there, right? Bringing in a bunch of littler, smaller checks where they're just happy to be a part of your business. They don't want to have a role. They don't, or again, a family office that's maybe more agnostic. Um, there are founders who have come to me and said, hey, I love my business. I want to grow it for the next 10 years, but I want to bring in a partner who can give me capital today, whether it's primary capital or secondary capital for some liquidity. If you have a horizon like that and you have no intention, or you don't want to be rushed, maybe you do exit in 3 years, but you don't want anyone putting pressure on you, you probably don't want to talk to traditional funds because they have a time horizon. They need to return capital. And so they have a 3 to 5 year horizon, and you don't want to have to sell for 10 years, or you don't want anyone telling you when you can sell. Why would you bring in somebody who's immediately day one not aligned with your vision? So I think, again, being upfront about what you're looking for and then finding money that aligns with that is really important. I've had some founders who say, I really want a partner who's done this, who knows what they're doing, who knows how to exit to a strategic, who can help me make sure that everything is in place, who can help me build the narrative, who can help me think through product adjacencies, distribution. If that's what you want, then you want to look for funds that have that competency, right? If all they are is investors and all they've ever done is invest and they don't have operational competencies, maybe they're not the best partner for that. Some funds have great operational networks, and so maybe that solves that problem for you, right? But I really think of it as like, what are your goals here in terms of who are you bringing into the table? Because these people are your partners, right? They're giving you money. They have certain expectations. You have certain expectations. It's better to address those expectations up front, because once the docs are signed and the money has gone through, like, you're stuck with each other.
Oh yeah.
As far as information is concerned, again, it sort of goes through what the expectation is. If you are partnering with people who are just happy to be there, it's probably a normal kind of quarterly cadence of updates, right? An email that's sort of maybe not even that. If it's someone who's you really want as your partner from an operational competency perspective or to add value there, they probably want a board seat. They probably want a real say in terms of what is happening with the business. Now, that can take a lot of different forms, but you should expect that someone you're asking to have a real voice is also going to want that voice in a board format, right? They're going to want real, I don't want to call it teeth because I think board seats can be really helpful, but they're going to want some teeth around that support. And so, all of these are puts and takes. And, when everything's going well, people care less about information. When things are going not so well, all of a sudden.
Funny how that works.
Yeah, really.
So even, if things aren't going well, even if you have a bunch of, smaller investors, they're probably going to want to know what's going on. So, I think communication is important, telling people what's going on. Again, not everyone, but depending on how you put your cap table together, being upfront about what your goals are, how long you expect, like these things all change over time, and there are things that happen and you can't account for them. But I think the conversation around horizon and, expectations around how they get their money back, right? This is not charity. And sometimes I don't think founders think of it as charity, but I think sometimes they forget that like these investors have investors, right? In almost all cases, they have a report, like they have their own reporting requirements, they have their own return requirements. And so you're one company in a portfolio, they need to also justify their investment. And that is in terms of a return that they have to give to their investors. So I just think being honest up front about what you're looking for is really important.
Right. Thank you. Alignment. Once again, that word comes up.
It's important.
Yeah,
Exactly.
So Teddie, you've seen a lot of small emerging brands come across your desk. Maybe share with our audience maybe some of the winning moves that you've seen small emerging brands and you're like, wow, these guys, they get it and they've just been really successful. Maybe share a couple of examples.
Yeah, I mean, I think some of it is, like I said, just incredible founders. And I've worked with some amazing people who, like, they're not going to give up. When things get bad, they're even when the business was like going this direction, they were still hustling. And I think that is so critical in this industry because, part of it is right time, right place, right? There is an aspect of that. But there also is just straight hustle, getting in front of the retailers, making a case for your business, getting creative in terms of how you distribute, having really new innovative ideas on, how to get to market, whether it's through building a community or, having a podcast or whatever it is, having products that resonate with your community so that you're aligned in terms of who you're serving, right? Who is this audience that you're going after? Who is this consumer that you're trying to have a conversation with? So, there are a lot of businesses I've seen where I'm like, that's a great idea, and they never go anywhere. And it's not because it's not a great idea. It's because they didn't have some other aspect. Either they weren't able to get funding or,
Right.
maybe the founder had other things. And I think what's important, Tracy, is like, there's a lot of great ideas that don't get funding. And it's not because they're not great ideas. It's because the funding environment sucks. And that's a fact of life. And so if you need money and you can't find it, it doesn't really matter if you have a great idea or not. And so, like I said, I think part of it is founders who have so much grit and they believe in their product and they're willing to just do whatever it takes. Part of it is luck and just being able to find support, getting the right introductions, meeting people at the right time, talking to the right buyer at the right retailer. Like those are hard things to have happen. Not everybody knows who to call at Walmart. It's very hard to get in front of the buyer. Surrounding yourselves with a network, having the right people to support you. And then I think building a business whose unit economics makes sense, whose pricing architecture makes sense, who, if you have an 80 or 90 or whatever $100 product, you're probably not going to sit at the shelf at Walmart. That's probably not the trajectory for you. Okay, so what is your distribution plan? How attractive is that? Does that make sense for the strategic buyers who are going to buy you? And when you find companies that have that they have a product that makes sense, they have a consumer that's interesting, and they have a price point that works. That's where you start seeing really interesting things happening.
That's great. Well, Teddy, we're rounding third base and heading for home. So take a second and tell us who's had the greatest influence on your career. And you don't necessarily need to name names if you don't want to, but what did this person, do for you aside the person in the bar in St. Petersburg?
I think it's interesting. I've been asked this question before, and I think there's two types of mentors. I think there's the mentors who you look up to, who you're like, I want to be like you when I grow up. This person's amazing. I love what they've accomplished. And you can kind of look at them and say, okay, these are where they are is where I want to be, or where they are, there are parts of it where I want to be. And what are they doing that's really impactful? And I think I have a lot of those types of people above me, obviously Fuad, but many others who I can kind of look at and say, wow, like what an incredible career trajectory. That's really admirable. And I want to be that type of person. The other type of mentor is the people you don't want to be like, the people who you sort of look at and you're like, man, like that's not what I want to do. That's not who I want to be. And I actually think in some ways that's more impactful. Not longer term, but just as you're starting your career and you can kind of, you're picking your path, you're picking what you want to do and sort of saying, okay, that's not what I want to do. Those aren't things that are interesting to me. How they operate is not how I want to operate. That tends to be easier, honestly, at least in my case, to immediately impact you. Because all of a sudden you're like on a phone call and you're listening to someone speak and you're like, that's not how I want to talk to clients, or that's not how I want to position myself. And so, I think it's always been a mix. I mean, I also, like, my mother started her own business. I watched her. She was an incredible founder and had incredible hustle. And that was very impactful for me before I started my career and even as I started working. But I think it's both of those things. It's both who do you want to be, but also who don't you want to be, and how do you sort of find your own path, taking in all of those things and then making it personal. I don't think I look or feel like anybody else I work with, but I think there are parts of each of them that I really hope I have because I admire how they approach business. And there are parts that I hope I don't have because they're not the things that I admire.
No, I think that's great. And it's so true, whether it's family members or people you work for or with or clients. I always say, everyone gives you a chance to put something in a pile, the good pile of stuff you really like, and the I'm never going to do that pile.
Yes.
And
yes.
So you're always making that progress. Tracy?
Absolutely. So, Teddy, I get to ask the fun question today. So tell us your favorite football team, brand, or band, and why.
So because I work in consumer brands, I have to be sensitive, and I music wise, I listen to every single thing. I have no loyalty there, so I can't give you something on that. And on football, I don't think I know any of the teams, so I also can't contribute on that. But I would say on the brand side, it's not so much a specific brand. I tend to try everything. I am the consumer's consumer. If I see something I like, I will try it. I have no loyalty. I will go, there are brands that I've stuck with, but it's because they're the best product. But otherwise, I love trying new things. I love seeing kind of how the world evolves and the types of new things people are bringing, how that product and the brand itself kind of work together. So I would say I don't have a favorite brand, but I love brands that really mean something, whether they're synonymous with their category. I mean, I look at some of the brands we've worked with and, like take a Kleenex or a Band-Aid or a Prestone, right? Those are synonymous with their categories. They are brands that have gone beyond a product and a specific brand and are just, that's what people think of as the category. Chapstick, companies like that. I think that's really powerful. But I also love the earlier brands that have such resonance in terms of what they're doing and have really been able to like capture a feeling, with what they're doing, especially in like wellness and consumer health, where it's so personal. And if you can build that trust and connection with your consumer, I think those are the brands that get me really excited. So again, it's not a specific brand for me. It's really like a feeling, like, am I compelled to click on this website? Am I compelled to try this product? When I try the product, does it do what it says it's going to do? Do I want to continue using it? And that list is, sadly, Tracy, constantly evolving and quite long.
Well, I'm glad. I like how you answered that, because that question about the brand would be like asking who's your favorite child. And so if you named a brand, you after people listen to this, you would
I'd
get
get in trouble.
exactly.
Although it is my honest answer. I thought about it ahead of this, and I was trying to think, like, do I have a favorite brand? And I was like, honestly, no. I love the ecosystem that I operate in, and I really get excited with all of the brands that I work with, and it changes over time. So that's really how I feel about it.
Unlike our children, right, Bruce?
I don't know. I was thinking about the favorite child. Every now and then I'll say, depends what just happened.
Yeah.
Hey, so Teddie, thank you so much for coming on the show today. If people would like to reach out and learn more about your firm and your capabilities, or bounce a question or two off of you, what's the best way to get in touch?
Either email or LinkedIn works. So my email is thtownsend@cgf.com. So people are more than welcome to reach out through that, or through LinkedIn also works.
All right. Well, again, thanks so much for your time today. It was a great discussion. Tracy, the big finish.
Absolutely. So, Teddy, you were awesome. I got to tell you,
Yeah.
such great insight. Our small emerging brand audience is going to love this episode. So, thank you again. And audience, continue to follow us on our Spotify channel, as well as Apple Podcast, as well as LinkedIn, and also our new website, www.road2retail.com. And we will see you soon.
Thank you both.
Good luck out there, folks.